Okay, everyone. Hello and welcome to this IC Markets webinar. My name is Chris Wilson and I am from Trade with Precision, and I welcome you all on board with me here today. There's quite a few of you on the webinar, which is nice to see. Some of the names I think I recognize from previous webinars, so welcome back. But first things first, just need to know that you can hear me. So if you wouldn't mind typing that you can hear me in the question box, that the sound is good, loud and clear, something like that would be really handy, just so that I know I'm not sitting here talking to myself, which would be highly, highly embarrassing. We do occasionally have the odd technical problem. Awesome, thank you, Godwin. Nice to see you on board. Excuse me, everyone. Early in the morning for me. Okay, awesome. A few more coming in now. So thank you very much for that, and do monitor the quality of the sound throughout the course of the webinar for me, if you wouldn't mind. Jennifer, welcome. And if there's any change to that, do let me know. But without further ado, we will carry on. Basically, the purpose of today's webinar is to just effectively do a market scan. Obviously, being a technical trader, as I am, we're in and out of the markets all the time. So I've always got an idea of, you know, what the markets are giving me. I do focus on currency markets. That's certainly where the action, I think, has been this week. I've had 7 trades already this week, and I want to run through those. They're all much the same in terms of their setup, but some of them demonstrate how we stalk trades. You know, you're always, as a trader, looking at the higher time frames, thinking, you know, where's the higher time frame momentum going here? Are we going up, or are we going down? And then you're waiting for certain criteria to play out. If they do, they do. If they don't, they don't. But stalking is, you know, waiting for circumstances to happen is a big part of trading, as in stalking trades. But then, you know, you get the others that just come along very quickly, and on the lower time frames, and you sort of have to be a little bit nimble to catch some of them as well. Yeah, so let's just have a look at some of those. If you have any markets that you particularly want me to look at, please do keep them in mind. But otherwise, let's just see how much we get to and how much information I can impart. Now, I will keep my question box handy, so if you have any questions, just type away. There's not too many of you on the webinar today, which is good. It means we can be pretty interactive, and I can just take questions as they come. But first of all, just have a quick skim of this risk disclaimer. Just make sure that you are aware of the risks involved in trading, and certainly do not put real money on the line prior to fully understanding that. Do excuse my coughing. Cool. So the agenda is pretty simple. It's basically going to be, let's just look at live markets and see what we find. I have not done a scan today being Friday for me. It's Friday morning at 8 o'clock in the morning. Have had a lot of trades this week, more than I normally get, to be perfectly frank, which is really nice. But you often find, you know, once trades have played out, once they've moved, the markets are in a position where they're overextended and you have to wait for the next move. Well, that's certainly where we are now. So I'm not sure I necessarily expect to find anything else for the remainder of this week. You often do get a lot of moves on a Friday. As markets around the world shut for the weekend, they, you know, like to have one final move before they close. Mondays, not always, but typically Mondays are a busy day. And Thursdays and Fridays are a busy day as well, more often than not. But this week it didn't quite work out like that. It was more like midweek that a lot of action happened. But we'll go through that and explain that. So recent moves in the major Forex pairs across multiple timeframes. That's really important to understand, multiple timeframes. You can't really just trade off one time frame. The slight exception may be the daily. The daily is probably the most important chart to look at. Some people do just trade off the daily. Mainly we're talking institutions and that sort of thing. I mean, that on any particular currency pair or any particular market, really, the highs and lows of the daily are really are pretty important. People do take notice of that. So the only possible exception would be the daily, but in general, you certainly don't take a trade off one time frame without looking at the ones around it, without looking at all of them, really. Because what might be happening on the higher time frames might be completely different to what's happening on the lower time frames. So multiple time frame analysis, really, really important, and we will obviously go through that as I sort of run through my recent trading. Identify and assessing the emerging trends. So again, you know, sometimes you're stalking opportunities, other times they present themselves incredibly quickly. What's emerging? Well, how do we assess that? I'm not sure there's anything emerging right now, but let's have a look, because I guess, as I say, my trading activity for the week I think is finished, but that doesn't mean we might not see something else coming, and we'll see that. Building a watch list of FX pairs to consider. So, you know, when you're looking through all of the foreign exchange markets, how do you decide, you know, what to trade and what not to trade, what to sort of prioritize on your watch list? Hint, if it's trading on the high time frame, it's got longer term momentum behind it. It's only a matter of time before, well, in theory, it's only, and it does work in practice, but no one has a crystal ball. But if the high time frame is trending upwards, it's only a matter of time before the lower time frames are going to follow suit. So the best trading conditions are very much when all time frames are moving in the same direction. That's really, really the ideal scenario, the ideal market that you want to see. So live market analysis, I think that's all the slides we have. So it's, as I say, pretty fluid, pretty flexible. No questions at this point. I'm just going to go to my live market, which is here. And let's see where we go. So this is what the IC Markets platform looks like. I assume you're all fairly familiar with this. Let me first of all show you, and forgive me, this isn't actually the platform that I trade on. This is a demo account, which we use for learning. So it's very similar, but slightly different to mine. Certainly the order of the currencies, they're all in alphabetical order, so more or less, so it should be fine. Let's just sort of do a top-down approach. And well, first of all, let me explain what happened last night. Okay. What you want to find is a market that's moving. Either going up or going down doesn't matter, as long as it's moving. Trading to the side, like it is currently doing, is not the most appealing situation for a trend following trader, because there is no trend. What is a trend? A trend is a series of, in the case of a downtrend, lower lows and lower highs. So here's a low. Okay, we know that trends move in waves, whether they're going up or whether they're going down. It is like waves crashing up on the shore. One comes up, it runs out of steam, and it retraces. Next one comes up, at some point it runs out of steam, and it retraces. So knowing where, knowing the strength of those waves, knowing when it's getting to the end of its run, when it's starting a new run, is really it is really the basis of our trading strategy. It's the basis of all trend following strategies, really. So first thing you want to find is a trend, which we've got here. And as I say, they can come at you pretty quickly, as they did here. But you want to see, okay, so first of all, we're a little bit mixed here, but point at which we, here we go, the point at which we make a low, a high, a low, a high, a low, a high needs to be understood. So at, you know, at what point do we start making a downtrend? Because let me just get the pen out. So, you know, as I say, an uptrend is a series of higher highs and higher lows. This is how trends behave, okay? But at some point, that's going to run out of steam, and you're going to either make an equal high or a lower high. Either way, you're going to fail to make a new high. And at some point, so then you might go into a bit of a range, you know, where you sort of, you know, you might make a higher high, but then you might make a lower low. And eventually you're going to make a lower low. So you're going to fail to make a higher high, and you're going to break the previous low. As soon as you do that, you know that you are actually, and you've probably done it here, you know that you are obviously going to go down at some point and make a lower low. So at the point where you fail to make a new high, the trend is over. You're now moving into a range bound pattern. The point at which you break the low and then make a lower high, and then that turns around, then you're into a downtrend. Okay, so it's really, really important to understand, are we going up, are we going sideways, or are we going down? Because they really are the only three states you can be in. And as I say, as a trend following trader, we're really only interested in markets that are moving. The next thing we put on our charts here is your moving averages. 1 second. Oh, where's my, sorry, I'm just getting my, oh, just checking any questions. No, nothing. Okay. The next thing we want to put on our on our charts is our moving averages, which is here. So this here is that I just use a simple moving average. So there's a 10 period moving average, a 20 period moving average, 50 and a 200. Now, what these do is effectively smooth out our price action over the short, medium and long term. If you can think of the human psychology of how trends work, that's really, really important. Let's take the housing market, for example. You know, and there's a lot of human behavior behind this. Over the long term, as I say, let's just take the housing market. So over the long term, there's reasonable demand for housing stock. People want somewhere to live, population growth, inflation, all of that sort of stuff generally means in most parts of the world the price of houses generally goes up, and commodities are the same. I'm just here using housing as an example. Stocks are the same in general. Inflation pushes things up, market forces push things up. Long term, generally you find prices move. But anyway, back to the housing market. So then you get people that come along and want to enter the market. Either they want to enter the market because they want to buy a house and they don't want to miss out. They see that it's a rising market. They see that prices are low and expected to rise, and they want to get in now. You also have investors that think, oh, there's opportunities there. I want to get in and I want to make some money here. Price is low, you know, the old sort of saying, buy low, sell high. That sort of thing really comes into play in terms of human psychology. So over the long term, the market is showing this sort of level of demand. But over the shorter term, because people are, you know, essentially greedy and just, you know, want to, you know, make money, the short term, oh, that wasn't very good. The short term sort of market pushes up higher. Okay, and it goes something like that. Now, at some point, the short-term buyers are going to run out. There's not going to be any more of them. They push the price up because they're buying more houses. And then in addition to that, people that are holding houses, like sellers, think, well, actually, it's a little bit overbought at the moment. I think the price is too high. I think this is a very good price. I might sell Or if you are an investor and you bought an investment property, then you think, right, time to sell. So when all that happens, you have a bit of a, a rounding, maybe a bit of sideways while the market figures this out. And then it sort of dips and the price comes down a little bit, even maybe past its long-term trend. And then the cycle happens again. People go, oh, housing, it's dipped and I don't think it's going to get any lower. So now is a good time to buy. And it goes up again. And basically the same process happens again and again and again. So you've really got to be aware of your short, medium and long-term trends. And that is effectively what these moving averages are telling you. And the space between the 10 and the 20 period moving average is really what we like to call the equilibrium zone. Okay, so where price pulls back into that zone, and I'm going to color it in here. You don't have to be terribly accurate. It can be close enough to the line. It's not an exact science here, but you want to see, what you want to see essentially is this pull down and pull back into that zone, to expect another pull down and pull back. What you're also seeing is the candles. You're in a bit of a range here, which is nothing to see. But then you pull into, but then you make a low with a whole bunch of red bearish candles, bearish, 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 bearish. But then suddenly you get a green one. So what does that green one tell you? That tells you that this wave has potentially finished its cycle. It's running out of steam, and you've now got a slight bullish candle. You've rejected the very low of that candle and you've put in a bullish candle. So that is a signal that the pullback, that the wave is pulling back. I know we're going down this time, but wave pullback. And then we get back into the moving averages. Okay, so that is, erase all drawings. That is the period that you really want to get in, particularly when, and forgive me because I need to know where, oh yes, horizontal lines are as well. You've also got support and resistance levels as well. Anywhere that the price has touched more than once becomes a support and resistance level. It becomes a sort of a memory point in the market where the price is likely to react to. So it's come down here and it's hit the same level once, twice, 3 times, and then it's broken through, finally broken through. When it pulls back into that level, it acts as a resistance level. So when you're approaching that level from the top, it becomes a support level. It's effectively the same level, but where you're approaching it from the top, it's a support level. Where you push down and then come back to test it again, it becomes a resistance level, but it is the same level preventing or helping to prevent the market go beyond, through it, if you like. So that is sort of the basis for that. So and that happens. That's the sort of trading that happens really quickly. So normally we do a top-down approach. So we're looking at the the monthly, and we see, what do we see on the monthly? We see really nice trending to the upside. So this is when you're looking through higher time frame monthly charts, figuring out what do you want to trade. You want to trade something that's moving like this. You don't want to trade it when it was doing this. Let's say that. That is boring. That is nothing. It's very hard to trade. Well, I mean, you can drill down to the lower time frames like we've just done and get little moves either way, but you've got to be pretty quick to get them. You can't necessarily predict them ahead of time, because in the context of the higher time frame, you really can't expect too much out of that market. As I say, you might find the odd one, but over the long term, I mean, if this was the housing market, it's pretty flat. So people aren't, chomping at the bit to get into this market because it's not doing a lot. Okay, really what drives markets is demand and supply. So you've got to identify where is that demand, what markets are showing, an excess of either demand or supply. and henceforth being driven either way. At the moment, this market is, the Swiss yen is moving up. So again, you're in a range here, but the moment you start making a series of higher highs and higher lows is something to note. The moment these moving averages become in order is worth noting. As I say, when you're in a range-bound market, these moving averages tell you absolutely nothing. They're all bunched up. That's not the purpose for which we use them. We use them in the context of a trend. So when the 10 period moving average will obviously react first, it's the quickest. Oh, what are moving averages, by the way? Let me just quickly explain that. So at each point along this line that vertically corresponds to the candle, right here, it is the average value of the last 10 candles. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The last 10 candles, it takes the average value of those candles and plots the line. So that's where the average value is. Okay, now that just smooths price out over time and tells you where the overall trend, the overall momentum is going. Heavily to the upside in the case of the short term. 20 period moving average is obviously, I mean, if you could probably predict that now, it's the average value of the last 20 candles. So 1 back to 20, however long that goes. The average value of the last 50 candles has been sort of trending up relatively shallow, and then all of a sudden it starts to take a slightly higher turn. And the average value of the last 200 candles. So this gives you that picture of what's happening short, medium, long term, which is really important to know. Now, this is a monthly chart, so even on a monthly basis, we still have momentum to the upside on this market. That is good to know. Next thing you want to know is, okay, when we're not pulling back to the, sorry, that was a dog. We're not pulling back to the buy zone on the monthly. We're moving too fast for the monthly, okay? You wouldn't, well, apart from maybe there and there, but you know, when you start pulling away from the monthly, you're moving too fast for the monthly. So you're not going to be taking a trade on the monthly. You're going to want to move down the time frames, and you're going to see, oops, weekly, and this looks better. So see on the weekly, so this is the time frame. So now every candle is a week's worth of trading. This is where we are. Excuse me. This is the speed at which the market is currently moving on the weekly. So it's the same market. Here we were, you know, doing nothing, and all of a sudden we started uptrending. Probably from here. Nice, you know, this is range bound. Nice up, nice down, nice wave, nice down. Pulling back into the moving averages every time. Nicely up, pulling back, nicely up. Sometimes you don't pull back, you just sort of slide in like that sometimes. Now, this happens on the weekly, okay, either the pull back or the slide in, because you're overextended on the monthly. You know, you've pulled up and you need to take a breather. You've pulled up and take a breather. You can see that with more detail as you move down the time frames. So, you know, going back in time, here we have rather big candle, but here we have an opportunity to get into the market. This is a very big candle, by the way. You don't normally go in on such big candles, but the basis behind the trend flow strategy is wait for the trend. You know, first of all, establish higher time frame momentum to the upside, so you know which direction you're going. Then wait for this series of highs and lows to form to see that, and then wait for your moving averages to fall into line, and then wait for a pullback into the moving averages, because that is where the equilibrium level is for the market. That is where you would expect it to pull back, sit for a while, and take off in the direction of the prevailing trend. Okay, Now, the other thing you want to see is what we've got here. We've got two indicators down here. You've got the MACD and you've got the RSI. What you're looking for there, if we just get the crosshair out, each time price makes a higher high, okay, high, higher high, higher high, higher high, you want to see your both indicators, the vertical line down there, doing the same thing. So that high is higher, or again, higher again, and higher again. So these are momentum indicators. Okay, that's telling you that each wave is actually stronger than the last. Now, these can be flat, as in, you know, each high is the same height on the indicators, and the RSI is giving you that picture here. Oh, kind of, it's a little bit higher. Your RSI is effectively giving you the same information, but from here to here, from this high to this high on price and this high and this high on price, the RSI is actually giving you a little bit of divergence. It's telling you that actually, no, this high is actually not as strong as this high on the RSI. So in actual fact, the two kind of cancel them out on those particular highs. One's giving you one reading and one's giving you another. Most importantly, as you're taking any, but when you were here, right, you wouldn't have known that, because you can only look at the most recent high in comparison to the one before it. Okay, so the most recent high there in comparison to the one before it. That's the most important thing. When, you know, as I say, you wouldn't see this until it actually plays out. So if you were thinking about going into the market here, again, that is a big candle, but that is the basis on which you would enter the trade. So enter at the top of this green candle with a stop below the low of the swing low here. Because why? If it does break the top of that green candle, chances are the next wave will come. If it doesn't and it moves below the low of this swing low, then your idea for your rationale for being long this market is no longer valid. Something went wrong, I don't know, or it just didn't happen for whatever reason, and the trade keeps going low to the downside. So if that plays out, you want to be out. Yes, you might have a loss, but you want to be out because you don't want to hold it, because, you know, it'll keep going down and you'll keep losing more. So trading without a stop loss is mental. Don't ever do that. You really, if there's one thing I'll tell you to absolutely always do, it's put a stop loss in. Never trade without a stop loss. You are exposing yourself to a whole lot of risk if you do that. But anywho, where we are now is sort of moving to the side, because we're a little overextended on the high time frame. So there's nothing to see here really on mid time frames. And as we go down the charts, you're just going to see the current piece of chart action in more detail, which is just going to be moving to the side. So from a high time frame perspective, we need to wait for another signal that this is going to take another run to the upside, but we don't have that yet. So if we go down the charts, obviously we're going to see just flitting up and down in a range while we figure out where we're going to go, while we pull back in probably to the moving averages on the monthly. It may pull down, it may move to the side and wait for the moving averages to catch up. Who knows? We don't know that yet, but at the moment, all we're doing is flitting up and down between a range. But that doesn't mean you can't go down the time frames and eventually see, well, even though we are in a range, here we're at the top of the range, so there's protection against going any higher. I mean, you've had a few ticks up there, but in general, there's a high, there's a high, there's a high on the 8 hour. Yep. So once you get to the top of the range, you know, makes sense that you'd probably fall back to the somewhere in the middle or at the bottom of the range, which is sure enough what's happened, although there's the bottom of the range, but still That's a bit of a level of support as well, because you've got that level right there. So, you know, as I say, range-bound trading opportunities can happen pretty quickly, like I've just explained, and all of a sudden it can turn. Your moving averages can get put in the right position. You know, here we have the 10 below, the 20 below, the 50, pulling back in nicely to the downside. We're doing that again now. If that turns into a nice red candle, it's too far on the 2 hour though. Too far on the 2 hour though. So you'd need to make sure that the 15 is giving you the same thing, and that's not really, because that's now just moving to the side. So you want to find at least 2 time frames that are giving you the same picture. Don't quite have that here. See what I mean? That although that looks good on the one, you really want to see some evidence below maybe of that turning around, and currently we're getting momentum still to the upside on the 15. Okay, so that is not in keeping with this turning around and falling again, not yet anyway. And the 2 hour is overextended. It looks like it's due somewhat of a deeper pullback, and the 4 hour certainly is also at a level of support as well. So what looks good on the 1 hour chart might not always look good on other time frames. So that's basically, sorry, 1 second, where are we? That's sort of looking at things as they come along. But more often than not, as I said before, our trading involves, 1 second. Yeah, you're all still here. Very quiet on the questions, but you're all still here. Your trading involves stalking, really stalking opportunities. This is what we do a lot. Okay, so let's have a look at this. So here is a market that I've been trading. Why have I been trading it? Because it's moving in a particular direction on the monthly chart. On the monthly and the weekly chart, it's moving. It's okay. I can see it's changed now, but it's been moving a particular direction for a long time. So it's certainly been one of the ones that's on my watch list. But at the same time, the monthly is giving us a downtrend. Nice. But it's overextended, and now what we're doing is pulling back. A bit of a gap here, but we're pulled back into the moving averages, and we're pulling back further. Yeah, so that's good to know. It is, and this month, by the way, is the 25th of November, so this month is nearly over. So chances are that candle will stay like that, more or less. So even though we're in a downtrend, it's a bit of a bullish month pulling back into the moving averages. We've still got downwards, you know, momentum on the monthly, but we know, and if it sort of pulls back to that level and then gives you a nice red candle, then that tells you, you know, upward momentum has run out of steam, and we may be turning to the downside again. And based on the monthly, that is kind of what you would expect. But at the same time, you've got a big monthly bullish candle, and that's going to look like an uptrend on everything further down. So that's fair enough. You know, on the weekly, you've now started to uptrend. You don't have your moving averages falling into line yet, but that's okay. You wouldn't be trading off that time frame. But on the daily, you're seeing that move to the upside in more detail. And sure enough, what happens here? You know, a little bit mixed around here, let's say. You're sort of nice to the upside, but you make an equal high. But okay, so an equal high is not necessarily, well, no, that's not an equal high. It is actually still a higher high. And then a higher low, higher high. You've made a lower low, okay, but you haven't really followed through with a higher or the lower high. You've then made a higher high. So, okay, we know we've got momentum moving to the upside on the monthly, back into the moving averages. We would expect that to stop at some time soon. but currently we've got bullish momentum to the upside. We've got the same on the weekly, and we've got the same on the daily. On the daily, look what happens. Big push to the upside, big pull back in to the moving averages, to this area here on the daily, and you put in a nice little, what we call a trigger. That was terrible. We call a trigger candle, okay? Now, the idea of you know, hover over that candle and you can see, excuse me. Can you see the values? Yes, you can. Hover over that candle, and at the bottom of the screen, you can see that the high is 1.379. Okay, so you probably want to get in at 1.378. Sorry, 1.38. That's probably where you want to get in. Okay, because if it does break the high of that candle, this move is highly predictable. Push up, pull back, push up. You know you're moving to the upside on the charts below, even if it is just a pullback on the monthly. Okay, when you see that, when you see this forming, okay, and bear in mind this is a daily chart, so there's only one candle a day. You got to figure out in your time zone what time a new daily candle starts printing, so you can assess the daily candle once it's finished. That's why there's more activity around the start and the opening and close of the day of each market. That's why the daily is important. Okay, but yeah, so anyway, stop above the high, entry above the high, stop below the low. So the low, if you look down the bottom, there's 1.3735 or 34, let's say. So you want to give it a bit of room, maybe put it at 1.3729. Okay, because obviously if it does break the low, 1.3729, then that might not happen. Okay, so you don't want to be in the trade anymore if your rationale for being in the first place is no longer valid. So remember that daily candle. Okay, so as we progress into the new day, okay, which was yesterday. No, that was yesterday. Hold on, what are we? We haven't started the new day yet, so got to figure out what time frame you people are on versus me. So that is the okay. So you can see there 10 o'clock. New daily candle prints at 10 o'clock. 9:30 to 10 is what I would call a daily scan. I want to be looking at all of my daily candles, going, is there a setup somewhere that I can get on? When we go, so again, remember the high of that candle, which was 1.379. Bearing that, you know, assuming that you now want to get it at 1.38. Or probably, being that's a big number, you might just get in slightly above that potentially. Go down the candles, go down the time frames, and then what you see here is, okay, on the 8 hour, this is the same piece of chart action. So you would see this sort of thing here. So an uptrend has rolled over, now given you 3 pretty much equal highs, starting to give you divergence on the indicators. Okay, which you would expect when, you know, it rolls over and starts moving back into its moving averages. Sure enough, that's what it's done. It's moved beyond the buy zone on the 8 hour. So you can't just trade based on the 8 hour. What you want to do is link the daily with some other chart. So you look at the, hold on. Okay, so the 4 hour, again, this is the level here. So this is sort of the 3 highs that we saw before. Again, divergence into those 3 highs on the indicators suggests to you that that has topped out and pulling back. Okay, so then you get a pullback, which is here. Go down the time frames again. There's your pullback just there. So again, your 3 highs, it's pulled back. It's, you know, a little bit spiky here as that happens. But if we go down to the 1 hour, as it's pulled back, it has made a lower, made a low, made a high. Okay, some news happened here probably. Let's just ignore that and just go, right, there's a low, there's a high, but we've failed to make a new low. Again, as you'd expect, because you're expecting that. So you'd expect it to fail to make a new low. You would expect it to turn around on the lower time frames. And sure enough, you get a level at about 138 where you'd expect it to be. There's a touch, and there's another touch at around about the 138 level. It's slightly below that. If you look, as you go down the time frames, you can see these levels with a little bit more accuracy. But we said the top of the high was 1.379. The top of the daily candle was 1.379. So you want to wait for it to break out of that, or you want to see. You could take a breakout strategy, as in you've identified a level. If it breaks up, if it breaks up that level, then that's where you buy. Or you could wait for it to pull up and pull back into that level. Okay, so there's the 1.38 level thereabouts. Don't know why I've got target in there. That's probably what I was looking at before, maybe, I don't know. But you know, this move to the upside was entirely predictable, I guess. And remember, this is all happening above 138. This is all happening above 138 after you've seen that daily candle finish printing. Bullish candle just below 138, ever so slightly below 138, or 10 pips below 138, fair enough. So when you see that, you know, you see that printing, you know you've got high time frame momentum to the upside, and you wait for the lower time frames to give you the same sort of picture. Push down, as in, this is the pullback on the higher time frames. This is the sort of sideways period while we figure out our next move, and our next move happens when we break the previous daily high at 10 pips below 1.38, which sure enough happened there. Then you get nice trending to the upside, which you can get on, all because you've noticed that sort of pattern on the daily and you've timed your entry and you know where to get in. Exactly the same thing has happened on the euro dollar recently. I hope you can just see that from what I've just said. Hopefully you can just see that. So, and really this is even better in some ways, because the top of this daily candle, this trigger candle, is actually slightly above 1.03. It's 1.0308. So if you had a entry of 1.310, you know, there you go, with a stop below the low, the swing low, then that's where you want to get in. So you've identified, this is much the same thing. I put a circle around that. Why? Because I was actually expecting, there's the parity level, there's one, as in €1 equals $1 US, which is a pretty massive level. I've put that in, well, I haven't put that in, but we can see that level is there. Before this big green candle happened, you would actually expect, this is a serious downtrend. You know, that monthly chart, how many months of consistent bearish price action? Why would you trade long when you see all of this? Well, on the monthly basis anyway. But even a monthly chart is obviously going to pull back. When you go down the time frames, it's obviously going to pull back at some point. So yes, you can trade the pullbacks, but look, it is better, I will admit, it is better to wait until it pulls back nicely and then resumes the overall trend, which is not what I was trading on any of these charts, because all of them are in a bit of a pullback state. and all of them are in a bit of a pullback state that seems to be finding the end of its pullback level, if you like. But why have I got a circle there? Because I would have been expecting price to pull back to the parity level, because that's a big level to get through, big mental block at that level, and probably continue to push down, because that's what the monthly was giving me. But it didn't do that. It pulled right. It took the opportunity for a deeper pullback, and it's going back into your moving averages. Would I have taken a trade based on that? No, because you've got to look down the time frames and see what you see. So yes, same picture, bearish momentum, but in the context, but now in a pullback to the moving averages. So so everything, again, everything below here is going to look like an uptrend, or at least for the next few time frames. Looks like we're a little overextended though. And the same thing, and sure enough, when you drill down the time frames, you'll eventually find the one that is timed right. In other words, you not your weekly. It's moving too fast for its moving averages on the weekly, but the daily, the moving averages are keeping up. So you're getting this zone between the 10 and the 20. That's what you want to see. You're getting price pull away and pull back into its moving averages. That's what you want to see. You want looking for sort of what's our direction over the short, medium, and long term, and where are we in terms of the stage of the trend. But again, 1.03 is your level that you're interested in. If it breaks the top of 103, this push to the upside was entirely predictable. What does that look like on the 8? Okay, pulling back. Okay, as you're heading down the time frames, what you want to see one of two things. You either want to see, okay, the daily or whatever time frame you're looking at happens to be the nice setup that you're looking for, and the 8 hour is the same. Like if the 8 hour was nicely showing you the same thing, then that's worth taking based on those two trades alone. But when you look down the time frames and the 8 hour has pulled too far back, as in beyond the buy zone, then that strategy is not working for you anymore. So you've got to go further down, and you've got to more assess this pullback. Has it ended? Is it is that a bullish candle because the market is turning, or is it just, say, a bullish candle because that is the natural momentum of the downtrend? So like, that could be a downtrend, and each candle is a day. So we could have had, there's a day, there's a day, there's a day, there's a day. So this bullish candle could simply be because in that day, predominantly we were in a pullback on the time frames below, and that may be the only reason why it looks like that. Okay, so that's why we're assessing lower time frames as well, and we want to go down and we want to see what is really going on with this pullback and resuming the uptrend. There's the pullback, still momentum to the downside. Okay, still showing lower lows. Well, actually, there's a high, there's a lower high, and there's a lower low. Okay, as we pull back here, what do we see? What does this look like? Downtrend. Yep, that all looks good. But pulling back into the sell zone here, so the 4 hour would look like, okay, we might be still pulling back, but the 2 hour, didn't pull back. We're still below 103. We're still below the daily, right? The daily high, but it hasn't pulled. You'd expect it to pull down back into the moving averages and continue to the downside, but guess what? It didn't do that, and now you're starting to get divergence on the indicators. that is a signal that it could be about to get in line with your daily. And then sure enough, on the 1 hour, you can then see, here's your pullback. Here's your pullback on the what time frame were we looking at? Whatever. But here's the pullback now starting to uptrend, heading up against 103, and you've now got a nice. Okay, so once you get above 103, which is the daily, which actually I think it was about 1.308 from memory, so that's about there. So you've pushed up beyond that level. You've now got moving averages. Look at that, like perfectly timed. The 10 has just crossed the 20, has just crossed the 50. Okay, the 200 is up here, but it's still moving to. It doesn't really matter where the 200 is, to be perfectly honest with you. If you wait for the 200, you're going to miss a lot of opportunities. At least the three of them are now giving you that nice fanning pattern. Push up to that level. 103 is the level. 103.08. 103.08 is the. To be honest, to be really accurate, 103.08 was the level. Okay, and what's it done there? It's pushed up beyond the level, and it's come back and come on, go away. And it's sat on. What are you doing? And it's sat on that level, and it's given you a lovely. It's given you a couple of nice bullish candles where you could have got in. Ride wave, up you go, and then it's done. And really, that's that's all you need. You really only need the distance between the top of that candle, the bottom of the swing low. You really only need that move, and you're done. Now, even once that happens, then you get a nice push up, pull back. If that's not quite 1.036, okay, if that's not quite in the buy zone on the 15, on the 10, sorry, on the 1 hour chart, what does it look like on that? Again, what is the time here? 1.306. What does that look like on the 15? Maybe you go to the 15, 1.0306. Where was that back here? Maybe it looks better on the 15. Okay, pulling back into the moving averages. It is a little bit messy. That's certainly a much better one. Slide into the moving averages, pull away, pull back nicely there, and move away. So if it's not fully back into your moving averages on one time frame, go down, and it might be there. Obviously doing nothing now, but here, these are the market conditions you want to look for. So that was the euro dollar. Exactly the same. I'm just going to fly through these because they're, as I say, they're pretty similar. The Aussie dollar was doing the same thing right there. The US yen, similar, but in the other direction, right there. I mean, that's what you want to look. As I say, I can't tell you what's emerging now because so many things have already played out. Once they've played out, then you basically have to go, well, the markets are overextended. We've now got to just wait for the next, what's the next move going to be? If we understand that trends move in waves, right? And the best time to get in is here, okay? Then when we're here, we just have to wait. We have to wait for the rollover or whatever it's going to do, and see if the next see if the next opportunity presents itself. But you don't want to be trading because now you've had 1, 2, 3 really big days of bearish momentum. It's used a lot of energy to get down to that level. Is it going to continue? I mean, you don't want to be getting in at the end of a trend. You want to be getting in at the start of a trend. So the US yen has been giving some nice. See, yes, this is the thing. really trading. We've all been trading to the upside, but just recently you've hit a massive level, 150. It's never been at that level before that I'm aware of. The main story of this month is a massive pullback on many different markets. And that's what's happening. Is the pullback going to continue back to the moving averages on the monthly? Maybe. We have to go down the time frames and assess that. So this is pulled beyond the buy zone on the weekly. So you would no longer be trading long. I mean, saying that though, yeah, that's a big candle. I mean, it's close to the buy zone. It is sitting above 140. But still, when you got these big pullbacks with a serious overextension on the time frame above, I'd be a little wary of that little daily candle. So seeing that on the daily there below 141, again, the low of that is 141.08. Do you want to trade before the 141 level? In theory, you'd probably leave it to 140.99 to get in. Pull up again, rounded top pattern on this pullback. We're going down to the 1 hour again. So this pullback, right, looks like rounded top pattern. You know, here's the pullback. Here's the pullback on the 1 hour. The pullback makes a lower high. Same thing, exactly the same thing. The pullback makes a lower high and then breaks the previous low to go on to make a lower low, and then it settles at a level which is pretty much the bottom, 141.07, pretty much the bottom of this daily. And oh, this is good. It's good. It's good how the levels sort of transfer between the different time frames, which is really good. But the low of that is, as I said before, 141.08. Put it, as I say, put it below, slightly below. That'll do. Perfect. 2 pips below 140, but by far before 141. Go down the time frame. If it breaks below that level, there's a beautiful support level there. Touch, 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 bang. If it breaks below that level, I want to be shorting that market, and look what happens. Could you get in now? Okay, because you are pulling back into the sell zone on the 1 hour. Well, move's already happened on the daily, and the 2 hour is it's still pretty close, but it's not. It's still showing you bullish candles. Okay, that's a bullish candle. Still showing you kind of bullish candles. Remember, this one's not finished yet. We don't know how it's going to finish. And your 4 hour is a little overextended, I think. And here's a big wave down, and here's a nice 2 bearish candles and a bullish candle following on the 4 hour. Looks actually like you're going to break above that potentially. On the 15, I wouldn't mind betting that there's divergence. No, yeah. So, and on the 1 hour, you're starting to, well, there's the low, yeah. There's a low. Oh yeah, of course. There's a low, there's the most recent low, and there's the one prior. Slight divergence on the RSI. MACD's flat, but slight divergence on the RSI. So I think the move's done. This is really what you want to be looking at based on the daily. So seeing those patterns on the daily or on the higher time frames, getting your momentum from the direction of the higher time frames and waiting for and waiting for other charts to fall in line is what we call stalking opportunities, and trading involves a lot of that. Right, I'll finish off the slides, which is which there aren't many. If you've enjoyed this, or if you need to make contact with IC Markets, this is the way to do it. No, that's it. Okay. Well, that's it for the webinar. I do hope you got something out of that. I mean, that's basically just really basically how I trade, day in, day out, how you sort of put it all together, how you read the charts and assess the momentum and put it all together. And I do hope you learned something out of it. And if you enjoyed that, do join us for more webinars. We're here to help you. We're here to teach you how to trade rather than what to trade. Yeah, I hope you enjoyed that, and I wish you all the best in your trading, and I hope you have a good day. All right, thanks everyone. Okay, bye-bye.